Hello guys, in today's video, we'll discuss what is inflation. Inflation is the decline of purchasing power of a given currency with passing time. A quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time. The rise in prices, which is often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. Inflation can be contrasted with deflation, which occurs when the purchasing power of money increases and prices decline. What causes inflation? There are three main causes of inflation: demand pull inflation, cost push inflation, and built-in inflation. Demand pull inflation refers to situations where there are not enough products or services being produced to keep up with demand, causing their prices to increase. Cost push inflation, on the other side, occurs when the cost of producing products and services rises, forcing businesses to raise their prices. Built-in inflation, which is sometimes referred to as the wage price spiral, occurs when workers demand higher wages to keep up with rising living costs. This in turn causes businesses to raise their prices in order to offset their rising wage costs, leading to a self-reinforcing loop of wage and price increases. Is inflation good or bad? Too much inflation is generally considered bad for an economy, while too little inflation is also considered harmful. Many economists advocate for a middle ground of low to moderate inflation of around 2% per year. Generally speaking, higher inflation harms savers because it erodes the purchasing power of the money they have saved. However, it can benefit borrowers because the inflation-adjusted value of their outstanding debt shrinks over time. Advantages and disadvantages of inflation. Inflation can be construed as either a good or a bad thing, depending upon which side one takes and how rapidly the change occurs. Advantages. Individuals with tangible assets like property or stock commodities that are priced in their home currency may like to see some inflation, as that raises the price of their assets, which they can sell at a higher rate. Inflation often leads to speculation by businesses in risky projects and by individuals who invest in company stocks, as they expect better returns than inflation. An optimum level of inflation is often promoted to encourage spending to a certain extent instead of saving. If the purchasing power of money falls over time, then there may be a greater incentive to spend now instead of saving and spending later. It may increase spending, which may boost economic activities in a country. A balanced approach is thought to keep the inflation value in an optimum and desirable range. Disadvantages. Buyers of such assets may not be happy with inflation, as they will be required to shell out more money. People who hold assets denominated in their home currency, such as cash or bonds, may not like inflation, as it erodes the real value of their holdings. As such, investors looking to protect their portfolios from inflation should consider inflation-hedged asset classes, such as gold, commodities, and real estate investment trusts. Inflation-indexed bonds are another popular option for investors to profit from inflation. Even a low, stable, and easily predictable rate of inflation, which some consider otherwise optimal, may lead to serious problems in the economy because of how, where, and when the new money enters the economy. Whenever new money and credit enters the economy, it is always into the hands of specific individuals or business firms, and the process of price level adjustments to the new money supply proceeds as they then spend the new money, and it circulates from hand to hand and account to account through the economy. Inflation does drive up some prices first and drives up other prices later. This sequential change in purchasing power and prices, known as the Cantillon effect, means that the process of inflation not only increases the general price level over time, but it also distorts relative prices, wages, and rates of return along the way. Economists, in general, understand that distortions of relative prices away from their economic equilibrium are not good for the economy, and Austrian economists even believe this process to be a major driver of cycles of recession in the economy. How you can survive inflation. 1. Be smart about keeping your cash. If you'll need your cash in less than a year, we suggest keeping it in a high-yield savings account. These accounts should increase rates as the Fed's fund rate continues to rise. for cash you plan to use in the next 1 to 3 years. 2. Focus on critical home repairs. A financial planner based in Atlanta says her high-earning clients have mostly been fortunate enough not to feel the effects of inflation. Things among homeowners have been slightly more complicated, though. Some clients who may have wanted to make repairs or improvements to their homes have had to put their plans on pause as the cost of materials continues to rise. For now, they're focused on making only critical repairs or upgrades that would significantly improve their quality of life. 3. Reconsider your home purchase. With housing prices rising all over the country, it can feel like this is a now or never moment to buy a home. Who knows if prices will stop rising, and if they do, will you be priced out? But even though the market is on fire and buying a home may feel urgent, helping clients calculate what rising mortgage rates would mean for their budgets, which may mean now isn't the time. We have been calculating how much of a difference in monthly payment there would be for every 0.25% of additional interest so that clients have a clear understanding of what higher rates mean for them specifically. 4. Get to know your spending. Spending in an inflationary environment can be hazardous to your financial plans, especially if you don't know how much more you're spending now than you used to. Philadelphia-based financial planner says he stresses the importance of tracking your spending with clients. If you don't know you spend $250 a month on groceries, you may not realize you are now spending $300. But if you know your normal spending, you can tell when prices are increasing and adjust accordingly, possibly cutting back or buying cheaper replacements. 5. Be prepared for inflation to stick around. No one wants to hear this, but financial planner of Rockville says high prices on food, gas, and entertainment may be around for a while longer, likely another year or so. That's primarily due to the Federal Reserve's plans to raise rates a couple more times through the remainder of this year. If they see demand as still being high enough to warrant a couple more rate hikes, then there is certainly potential that inflation could continue to creep up a bit more from here. So, what can you do? Keep breathing and do your best to budget accordingly. Things will settle down eventually, though we may just have to get used to higher prices. And if you missed something, then here is a quick summary of the entire video. That's all for this video. I hope you enjoyed it. Let us know your thoughts in the comment section below. If you haven't already, then don't forget to subscribe and press that like button. Also hit the bell icon so you could never miss new updates from us. Stay safe, and we will meet you in the next one.